Okay, let's dive right into this. Before we get to the magic numbers, the really exciting part that tells you if a stock is an absolute steal, we need to understand exactly where those numbers come from. Every single public company is required by law to publish 3 financial statements. Think of these as the company's medical records. You're the doctor, and this explainer is your guide to reading them. Before you invest your money, you run the tests.
Seriously, how many times have you, or maybe someone you know, bought a stock just because the price was going up? Or maybe because of a flashy news headline? We've all been there. But that is investing blindly based on pure emotion. So, how do we avoid that? How do we diagnose a business's true underlying health so we can invest with absolute confidence?
Well, to do that, we have to establish a clear diagnostic process. Just like a responsible doctor would never ever prescribe a treatment without first running some blood tests or checking vital signs, you should never invest your hard-earned money without looking under the hood. Before we find those magic investment numbers, we absolutely have to run our mandatory tests.
And there are exactly 3 mandatory tests we need to run. Test 1 is the income statement. Test 2, the balance sheet. And Test 3, the cash flow statement. Let's get right to it.
Test 1, the income statement. We can call this the report card for profitability. Basically, I want you to think of this as the company's report card to see exactly how much money came in, what it actually cost to generate that money, and ultimately, what was left over.
And this brilliantly illustrates the top-to-bottom flow of a business's profitability. You start right at the top line with revenue. That's the raw money coming in. Then you subtract the cost of goods, which leaves your gross profit. From there, you deduct the everyday operating expenses of running the business, along with things like taxes and interest. And what you're left with at the very bottom, that's your net income.
Now that net income leads us directly to a vital metric, earnings per share, or EPS. You simply take that bottom line net income and divide it by the total number of company shares. A consistently growing EPS shows incredible management efficiency. It proves the company actually knows how to turn $1 of sales into real tangible profit for the shareholders. It's an absolutely crucial marker for a healthy business.
When you're looking at the income statement, you are hunting for patterns. The ultimate green flag? Both revenue and EPS growing consistently by 10 to 15% annually. That is a beautiful, healthy business right there. But the red flag? That's when a company is growing its revenue, but its EPS is actually shrinking. That tells you their costs are spiraling completely out of control. They're going backward on profits, and you know what? That is a business you want to avoid at all costs. You want both revenue and EPS growing together, year after year.
Moving right along to Test 2, the balance sheet, or the scale of financial strength. If the income statement is like a video showing a year in the life of a business, the balance sheet is a photograph. It's a snapshot of a company's absolute financial strength, frozen on one specific date.
The balance sheet functions a lot like a giant scale, governed by one really simple equation. Assets equal liabilities plus equity. Assets are everything the company owns. Liabilities are everything the company owes to others. The difference between those two? That is shareholder equity, the actual book value that belongs to the owners. And yes, that includes you. A truly healthy company will always have a massive slice of equity compared to what it owes.
If corporate accounting feels a bit abstract, just apply it to your own personal finances. Imagine you own a house worth $500,000, a car worth $30,000, and you have $20,000 in savings. Your total assets are $550,000. Now let's subtract your liabilities, say a $200,000 mortgage and a $15,000 car loan. What's left over is $335,000 in net equity. A company's balance sheet works the exact same way.
But here is where you have to watch out for leverage. 2 times. That is a stark, critical threshold. If a company's debt-to-equity ratio climbs above 2 times, it means they are highly leveraged. Sure, in a booming economy, they might survive. But in an economic downturn, that massive debt load can be absolutely fatal.
To summarize our second test, the green flag on a balance sheet is a mountain of cash. Large cash reserves act as a shield, allowing a company not just to survive crises, but to swoop in and acquire weaker competitors at a massive discount. The red flag, on the other hand, is that fatal danger of over-leverage, a debt-to-equity ratio above 2x.
Now we arrive at Test 3, the cash flow statement, better known as the lie detector. I want you to pay very close attention to this one, because honestly, this is my absolute favorite statement. It is the most honest document a company produces.
Here's a punchy realization for you. Companies can, and totally will, use legal accounting tricks to manipulate their income statement. They can pull forward revenue or defer expenses to make things look better than they are. But you cannot fake cash. Cash either moved into the bank account or it didn't, period. That makes the cash flow statement the ultimate lie detector of financial analysis.
The cash flow statement is broken down into 3 simple sections. First, operating cash flow. This is the cash generated directly from the actual business itself. And listen to me, this is non-negotiable. It must be positive. Second is investing cash flow, which tracks cash spent on future growth, like buying new equipment. And third is financing cash flow, which tracks the movement of debt and shareholder dividends.
So the crucial point is how these numbers combine to reveal free cash flow. This is simply your operating cash flow minus your capital expenditures. Warren Buffett famously refers to this as the real owner earnings of a business. It's the true unadulterated cash that the business generates, which can actually be used to reward you, the investor. When you're checking the lie detector, the green flag is finding 5 years of consistently positive and growing operating cash flow. That right there is a genuine cash machine, the foundation of a great business. The ultimate red flag? If a company boasts about massive paper profits on their income statement, but their operating cash flow is negative, that means they are burning cash just to survive. When you see that negative operating cash flow combined with reported profits, close the report and walk away immediately.
The final diagnosis, preparing for the magic numbers. Let's step back for a second and look at the whole picture. As the doctor in this scenario, it's time to summarize our patient's exam results before we clear them for investment. Let's do a quick recap so you have an actionable mental model. Test 1, the income statement, proves profitability and growth. Test 2, the balance sheet, proves absolute financial strength and measures the danger of debt. And Test 3, the cash flow statement, acts as your lie detector and confirms the cash is actually real.
So I leave you with this question. Does the stock you're currently holding, or maybe the one you're thinking of buying tomorrow, actually survive the corporate medical exam? If you can confidently read these 3 statements, you have built the foundation of fundamental analysis. You're no longer guessing, you are diagnosing. Now that we know exactly where the numbers come from, you are perfectly positioned to learn the 4 magic numbers that can screen any stock in 5 minutes and identify those deeply undervalued companies.